Hey everyone, welcome back to Corporate Decoder, the place where we decode the most important corporate news for you. This time we're digging into Chainbridge's latest financial report, and let's just say it is a real page turner, folks, filled with more twists and turns than a mystery novel. Before we dive in, if you love getting clear, no-nonsense breakdowns of these dense financial filings, make sure you hit that subscribe button. We also have a fantastic community growing on Discord, so join us there for even more insights. Let's jump right into the numbers with their condensed balance sheets. This tells us what the company owns and what it owes. Right now, as of the 30th of September 2025, Chainbridge has total assets of about $6.5 million. That sounds like a good chunk of change, but where is it all tied up? A big piece of that is over $5.4 million in their investments held in trust account. Think of this as money set aside, usually from their initial stock sale, waiting for a deal to happen. Their actual cash on hand is just over $1 million, which is up quite a bit from about $130,000 at the end of last year. On the flip side, their total liabilities are a hefty $5.2 million. This includes money owed for things like accounts payable and accrued expenses, but also some bigger items like bridge financing and senior notes. It is crucial to see how much debt they're carrying relative to their assets. Now, let's look at how they've been performing. Their statement of operations shows their income and expenses. This company, being a special purpose acquisition company or SPAC, doesn't really have operating revenue because it is still looking for a business to buy. So, their results are mainly driven by how the value of their financial instruments changes and their operating expenses. For the 3 months ending the 30th of September 2025, they reported a net loss of over $1.3 million. This is largely due to a big change in the fair value of their derivative liabilities, which looks like a loss of about $1.06 million. Think of derivative liabilities as complex financial contracts whose value can swing wildly. On top of that, they had general and administrative expenses of over $200,000. Contrast that with the same period in 2024, where they actually reported a net income of about $326,000. What is the big difference? A positive change in the fair value of their derivative liabilities. Essentially, the financial markets moved in their favor that quarter, giving them a boost. This highlights how volatile their financial results can be, not based on business operations, but on market fluctuations of these financial instruments. This section shows how the owner's stake in the company has changed. Remember, they have a shareholders deficit, which essentially means the liabilities and redeemable shares are more than their assets. As of the 30th of September 2025, this deficit is over $4.1 million. This is a really important indicator of financial health. It means that if the company were to liquidate today, there wouldn't be enough assets to cover all claims, including those from shareholders who might redeem their shares. Looking at the prior year, the deficit was also significant. They had a net loss of over $1.3 million in the third quarter of 2025, which just adds to this deficit. This is where we see the actual movement of cash. Over the 9 months ending the 30th of September 2025, Chainbridge used about $410,000 in operating activities. This means their day-to-day search for a business combination is costing them cash. They also had activities related to investing and financing. What is interesting here is the large inflow from cash withdrawn from trust account in connection with redemption. In 2024, reflecting shareholder redemptions. In 2025, they raised cash through loans and notes, like the $1 million proceeds from senior note. Now, let's understand what Chainbridge actually does. They are a blank check company, a SPAC formed to merge with or acquire another business. They had their initial public offering back in November 2021. Since then, their main activity has been looking for that perfect business combination. They have a deadline to do this, and if they don't, they have to liquidate. They've already extended this deadline multiple times. This is always a red flag. The company had to restate its financial statements for the 30th of September 2024. This means their previous numbers for that period were wrong. They found errors in how they accounted for their bridge financing note and prepaid expenses. This led to an overstatement of net income back then. While they've corrected it, it shows a lapse in their financial reporting and internal controls. Here is where we get into some technical accounting, but it is important. They note here that they are an emerging growth company. This allows them certain flexibilities in reporting, but it also means their financial statements might be harder to compare directly to other larger companies because they can delay adopting new accounting rules. They also mention they are not currently deemed an investment company, but there is a risk they could be. This is a complex area that could force them to liquidate if regulators decide they're operating like a registered investment company without the proper registration. Chainbridge has issued a lot of warrants. These are basically options for people to buy the company's stock at a set price in the future. They have public warrants and private placement warrants. The key thing here is how their value can change and what happens if the company's stock price goes up or down. There are specific conditions under which these warrants can be redeemed or exercised, and they can expire worthless if the company doesn't complete its business combination. This is where we find out about potential future obligations or uncertain events. They mention a business combination agreement with Phytonix Bio, but then they also state that both parties mutually agreed to terminate this agreement. This is significant as it means their planned merger with Phytonix is off the table. This leaves them back to square one in their search for a business combination. They also note a recent notice from OTC Markets Group about not meeting public float requirements for continued listing on OTCQB. This means their stock might be delisted from that platform if they don't fix it within 90 days. This is a critical section where management discusses the effectiveness of their internal financial controls. And here is the stark reality from their report. They admit that their disclosure controls and procedures were not effective due to a material weakness in how they reviewed and reconciled liabilities and prepaid expenses. This directly relates to the restatement we saw earlier. Management is taking steps to fix this, but this admission signals a significant concern about their financial oversight. This item details important events that happened recently. The OTCQB notice we just mentioned about the public float requirement is highlighted here again. It is a clear sign that they're facing challenges maintaining their exchange listing. Now, let's put on our Warren Buffett hat and look at the bigger picture. Chainbridge I is in a tough spot. They have a looming deadline, which has been extended to November 2026. If they don't find and complete a business combination by then, they'll have to liquidate. This means shareholders would get back whatever is left in their trust account after paying creditors, and likely wouldn't see a return on their investment. The termination of their business combination agreement with Phytonix is a major setback, pushing them back to the drawing board, plus the admission of a material weakness in their internal controls, and the potential delisting from OTCQB creates significant red flags for investors. Their financial statements are heavily influenced by market fluctuations in derivative liabilities, not by core business operations, which is typical for a SPAC but carries inherent risk. The key takeaway here is that Chainbridge I's future is highly uncertain. They are burning cash while searching for a deal, facing regulatory scrutiny, and have just lost a major potential merger partner. The fact that they have a shareholders deficit means that if things go south, shareholders could lose their investment. The company's direction is unclear, and significant risks loom large. What is your take on Chainbridge I's situation? Do you see a path forward for them, or is liquidation the most likely outcome? Let us know in the comments below if you found this breakdown helpful. Please give it a thumbs up and subscribe for more in-depth looks at corporate filings, and don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next video.